Good evening, all. Ira Epstein with your financial market weekend edition of your financial markets. Good evening, all. Ira Epstein with your weekend edition of your financial market updates. And this is for Sunday, the 8th of January, 2023, about 6:50 p.m. I had the flu over the weekend. I would have put out the updates in a regular way. It put me down. It wasn't COVID. I got hit with that stomach flu variety, and I'm still not feeling that great, but took the time off today, slept a lot, and that's what it is. It's going around, and there's not much you can do. So this past week was the week of the jobs data, and what we saw is the wobble in the wage price increases. It's a wobble. This does not mean they're coming down. They're not accelerating at the same rate. Now, what we're going to get this week is going to be the Labor Department CPI number. That'll come out at the end of the week. And that's the number that, if it's too hot, keeps the Fed still saying maybe we should go 50 points. If it's on the weaker side, they go to 25 points. We're going to have to take a look at it and see what it says. They're estimating about a 0.3% increase, but about a 5.5% increase of December over December. So those are the numbers that I'm looking at to see what they're going to do. More important to me, I was writing tonight's market letter for my subscribers. It'll go out about 40 minutes from now. And as I started putting it out and I'm looking at the charts, it dawned on me what we had. If you remember, we made a June low. We broke down, took out in this quarter those lows, if you will. Didn't really go anywhere. And we had an attempt back up at a rally, and you're still doing that part of it. That's what I think is going on. More important to me is the fact that when we took out those June lows, we really didn't go anywhere. The break wasn't material. It has me thinking that if the way it's going to go is that labor is going to stay relatively strong and wage price pressures slip back a little bit, it actually adds to the case that any recession that we're going to get will be contained very nicely by a good jobs market. And I wouldn't get overly bearish in my thinking that the stock market's going to have just a terrible, terrible time in 2023. No, I'm not thinking the market in the first part of the year is going to go anywhere of importance. In fact, I view this rally as overall a rally that's going to fail, because I'm going to look down the road here at earnings coming out from all the corporations and think they're going to get just worse. But when we take a look, and remember, we are open tonight, so you're starting the week up 1.68%. Well, you're still in the month, so let me take that back. There's a monthly chart. So for the month, going into the second week, you're up 1.68%, but still well under the 4,200 level, which keeps on a long-term basis downside pressure. When I go to the weekly chart, you're up about 0.25% starting off. The market, as you know, slipped down for the past couple of weeks, went to the 18-week moving average of closes and held it. When we look at the overall picture, and I just step back, what strikes me is from this high to this low is the trading range. And you're just trading about the center of that range. Next, I look to see, do we have a pattern that says there's a trend? And you don't on the weekly chart. What you have is a higher high and then a break low. Now, this is that low in June, and this is that low that you made this quarter that I started off talking about. And that's why I'm saying if you take out these lows, I'm not thinking it's going to do much worse than it did when it took out the June low. That's just my thinking at this point, looking forward, and obviously fundamentals will change. When I go to the chart picture, the fact that I don't have a swing line trend tells me, okay, what do I have in terms of relation to moving averages? Well, the bias is up since the market is over the 18-week average, but this type of pattern cannot give a buy signal anytime soon. In order for it to give any signal, if it takes out 37.88.5, it throws out a brand new sell signal, calling then for 36.78.90, 36.79, let's call it. When I look at resistance, up at the upper Bollinger Band, 39.25 to 41.28. Near-term support, 38.53, let's call it. And the support, like I just said, maybe the 200-week average, 36.79. And momentum pointing up a little bit, but not on fire to the upside. Okay, I'm going to repeat. I don't see anything here that can throw out a brand new buy signal the way that I teach charting. In the Dow, it was the same thing. If I take you to the June lows and you took those out, you didn't really get on fire. We are, just like we are in the other markets, we're over the 18-week average, so the bias is up. The battleground is and has been, back ever since October, the 100-day average to the 18-day average. But after you hit the 100 on a weekly chart, I said day, 100-week average. After you hit the 100-week average, you never did go to the Bollinger Band, and you've never returned to the 18-week average either. So you're just sort of hanging there. Are we embedding? No, you're just in what I'll call an overbought area. In the NASDAQ, the same thing. The June low, then the lower and low. This market's still more bearish. Now, everything I read, including today's reports, are, gee, when interest rates really start to break, the area you want to get back into is the tech, because that's the area that'll rip to the upside. Okay. But this chart's not saying that at this point in time. In fact, it's more bearish than the other charts. You have a higher high and a lower low. The resistance is much more pronounced here at the 18 and the 200-day average of closes. Then when we go to the Russell, it too is in a resistance area. You're at the 18-week average and the 200-week average of closes. The market's got a pattern, though, of higher lows, higher highs. Unlike the other stock indices, a close over 18.15 does trigger an upside momentum. Your risk would then be back under the most recent low of 1730.80, and you'd look for the upper Bollinger Band. In the 30-year bonds, the market is in an uptrend. Higher lows, higher highs. If the trend can continue, then you're looking at 133.22 as a potential resistance area, supports at 126.12, and the market turns bearish on this whole pattern if 124.11 is taken out, then looking back for 119.1. When I look at the 10-year note, the trend is up here as well. Higher lows, higher highs. Target, the 115 area, support 112, 109, the downside target if it lets go. And in the dollar index, as you can see, we have a market with a higher high and a lower low. So where are we? On a weekly basis, which makes all the sense in the world, we went into that flat pattern in December, if you'll recall. So we had several weeks in a row going nowhere. We ended up the year with a minor Santa Claus rally. Any way you look in the books, it's going to go down. It's a Santa Claus rally. Feeble, about a 1% rally, nothing important. But remember, the last 2 days of January were solid up days, and then you take the days just prior from around the 23rd, 24th forward, and that's what it did. So I look at all that and I put it together and say, okay, where's that going to carry the markets this year? And that gets to be the interesting part. So I can see why there's some slippage back and forth. The power I see still in the eurocurrency. It's embedded. It tells me on a weekly chart that the pros are buying this market until the red line closes under 79, looking for that 110 area possibly. In the Canadian dollar, it's joined the foray against the dollar in a bullish trend until the market gets back under 73.10. In the Japanese yen, the market's embedded. Until it loses it, it stays bullish. So there's a theme here. The dollar's got the weakness. In Bitcoin, I can see an argument that the market might try to rally towards the 18,036 level, but that'll be a resistance zone on the chart, the 18-week average of closes. The energies are still in the weakness, but as I told you during the week, I think this is all predicated on when China gets its peak in COVID and goes down the slope the other way, and we start hearing that things are getting better. The problem is, as the World Health Organization said, there's no transparency coming out of China. I'm seeing that even smaller countries are now putting travel bans in place on Chinese travelers, 48-hour test to arrive. So China can make all the noise they want. They want to retaliate against countries. Guys, you're the ones with the big COVID cases. Calm down. Get the 48-hour test. Mexico's not the U.S. enemy. When I was there last year, you had to get a 48-hour test. It's not a difficult thing. When you take a look at Brent, you can see how the trend is still down. Support evident as I see it between 74 to the 70 level. The market momentum still pointing down, a bit oversold. Same in WTI. You can see how the market came up. We had a crossover that's bearish where the 18-week average got under the 100. Supports back at 68.90 to 65.35. Gasoline prices still on the downside here. You know, you want to keep your eye on this one because sooner rather than later, the spring plays for demand for gasoline start moving in. You don't wait for the driving to pick up. The market will anticipate it before it actually comes in. So there's a lot to be looked at right now in the markets. And as you can see, you're getting pretty good action as the market is trying to climb a little bit here. I think this is all good news. Now, what you have to keep your eye on this year, and you've got to do it, is learn about Bollinger Bands. They're the most important thing that I can think of for a trader because it tells you, number one, support resistance. Number two, when you get the momentum shift out of the slow stochastic with it, it tells you before time, often, not all the time, but often, that the momentum's about to shift and you're going to lose that trend or you're going to get a correction within the bigger trend. How do you learn this? Take a look at this. Welcome. I'm Ira Epstein, and I'm here to talk about my enhanced Bollinger Band course. Now, many of you have taken my regular charting course, and if not, you might think you know something about Bollinger Bands. As you know, Bollinger Bands are an algorithm designed to keep the market trading within it 95% of the time. And on a chart, it will offer on the top part resistance, on the bottom support, and the idea is the market will travel within them. We know that sometimes it latches onto that band, goes up or goes down. Well, how do you play with that? Can you pyramid the positions off that type of thinking? Well, I've applied all three of these into 13 different videos that teach you my concept of it. And from that concept, you're able to work with weekly charts and or daily charts. The 13 videos, each about 7 minutes long. The idea here is not to put you in school forever, but to teach. Now, if you haven't tried my complete futures research, I throw that in as well. Whether you've tried this or not, I think it's worth taking a look at. I think you're going to learn something from there. That research, by the way, covers twice daily market updates for you and access to what I call window envelope numbers, which I think are very important when looking at these Bollinger Bands. The next part is a trial to our charting software so you can make your charts look the same way that mine do. It's that simple. Where do you go with it and how do you get all this? It's simple. You go to our website, www.iraepstein.com. If you go to the word education, everything you need is answered there. You can also call my staff. They'll be happy to help you get set up. I'm Ira Epstein on the road to your education.